When it comes to Canada's Big Six banks, Scotiabank is one of the more popular options with solid dividends, good growth potential. But are they a good investment? Fasten your seatbelts, folks. This is going to be a good one. Scotiabank today is a story about preparing for a wave of mortgage renewals. A lot of low-rate mortgages were taken out during the pandemic when, well, interest rates were extremely low. These mortgages are now coming up for renewal at much higher rates. A lot of people are struggling to figure out how they are going to manage substantial increases to their mortgage payments. Unfortunately, some people will default on these mortgages, and that will put pressure on banks like, well, Scotiabank. It's also going to eat into their loan loss provisioning. The overall Canadian market is projected to see around $250 billion in mortgages come up for renewal in 2024, with an additional $352 billion in 2025. Preparing for the massive wave of renewals will be putting Scotiabank's loan loss provisioning preparations to the test big time. Rate cuts will help 100%, though the timing will be hugely important. Scotiabank have reported that rate cuts in Mexico and Peru over the last few quarters have really helped consumers down there with renewals. They are hoping for the same thing in Canada. We do have 2 rate cuts on the books, and with most renewals set for 2025, they are hoping we see at least, well, 2 more rate cuts in 2024, and then early and aggressive cuts in 2025. Scotiabank is sitting on a lot of cash for loan loss provisioning and is prepared to set aside even more if necessary. They also do have the option to borrow more money from the Bank of Canada if needed. Without any doubt, the loan loss provisioning and this wave of mortgage renewals will be a driving force in the overall profitability of Scotiabank as well as the other big banks. There is a little bit of uncertainty with how it is all going to play out, but as we move into deeper rate cuts, that level of uncertainty will decrease for sure. If you are looking for something with more certainty, a sub to the channel will get a huge thanks every single time. 100% return on investment for sure. The data for this deep dive is being pulled from their Q2 report that came out at the end of May. At the end of August, they will release their Q3 data, which I can't wait to get my eyes on. Of course, I will have a video out in the first week of September with a review of the Big Six earnings hits and misses. We will take a quick look at a few items in that Q2 report. Their net income was up year over year from $2.1 billion to $2.2 billion. They also had an increase of 5% on their earnings per share, which is pretty good. They reported strong loan and deposit growth in Canada, as well as an overall improved performance in their Latin American banks. In fact, they do have long-term goals to expand their presence in Latin America. In regards to risk management, they have a CET1 ratio of 12.3%. I know, this is a new ratio to the channel. This is the Common Equity Tier 1 ratio, which is, in a nutshell, a measure of how well a bank is positioned to handle losses. A higher ratio indicates a stronger capital position that can withstand financial stress and thus, of course, protect depositors. Regulators typically require banks to have at least a score of 6%. A 12.3% is very strong and does indicate that Scotiabank has robust capital position that will act as a very nice buffer to absorb losses. Okay, it is time to get up all in close with the numbers. And if we're going to get mathematical, we are going to need to call on the director of division, the sorcerer supreme of subtraction, the one and only Mr. Math. We will start with a little bit of their surface data. At the time of recording, their current value comes in at $62.39. They've got a market cap of $76.64 billion. Very average beta of 0.96. Those earnings per share coming in at 6.01. They have a price to earnings ratio of 10.31. The average amongst their peers, 12.2. Those peers include National Bank with a PE of 11.6. TD has 12.8 and BMO at 13.6. Their price to book ratio comes in at 1 exactly. The average amongst those same peers, 1.3. Their return on equity, that's coming in at 10.91%, and their return on assets, 0.57%. These numbers look fine, and you can already get a sense that we are looking at a blue chip stock. So let's dive in a little deeper and take a look at their cash situation. They have a current revenue of $29.54 billion, and their earnings are coming in at $7.36 billion. Those earnings, they're projected to grow by 7.17% per year. Their profit margin sitting at 24.9%. Their free cash flow comes in at $35.17 billion, and they have an operating cash flow of $35.78 billion. It does make sense to see a lot of cash, and I do expect that when we get into the debt, we will also see a higher than normal cash and cash equivalents. This is all about those loan loss provisions. If we look at their fair value, so their current value sits at $62.39. We get a fair value from a discounted cash flow model of $131.37. That does peg them as being undervalued by 52.4%. Looking at their one-year target, that's coming in at $68.07. So analysts are expecting a 7.5% increase in the next year. These numbers are not bad at all. And I do suspect that if the Bank of Canada cuts more aggressively than expected, we could see these numbers improve, especially that one-year target. Okay, it is time to peel back another layer and jump into their dividends and returns data. When it comes to their dividend, they have a yield of 6.695%. That is a quarterly dividend of $1.06 per share. The payout ratio on that, 70.55%. Their 5-year average dividend increase, that's coming in at 3.56%. I am expecting them to hike that dividend at the end of August quarterly. Before we look at the returns, I do want to point out that the returns data for this deep dive was pulled during a wee bit of a crash. So some of these values are a little lower than normal. To put that into a numerical context, these ROIs, they're skewed down by roughly 1.5%. On the 3-year, their return on investment comes in at negative 22.73%. Add in the dividends, we get a total return of negative 7.47%. On the 1-year, their return on investment comes in at negative 2.58%. Total return sits at 4.04%. Year to date, that total return comes in at negative 1.25%. Sprinkle in those dividends, we get a total return of 3.78%. These numbers are not super, as the struggles of the banking sector are very well reflected in the data. However, this is a sector on a slow recovery that will pick up on the other side of the mortgage renewal wave big time. It is time to take the final trek down into what could be the most important data in this deep dive, their debt data. They have a total debt of $257.58 billion. Banks do traditionally carry a lot of debt. It is part of their business model, so never fret when seeing those big numbers with a big bank. Their total equity, that comes in at $81.08 billion. That's a debt-to-equity ratio of 330%. I will point out that 5 years ago, they had a lower debt-to-equity ratio as it was coming in at 235%. Keep in mind, they have financed a lot of their expansion into Latin America using some debt for sure. Now, that cash and cash equivalents, $422.81 billion. Oh, holy banana bread. Okay, so I expected this to be a big number, but it is really big, and it is a massive reflection of their loan loss provisioning. Scotiabank is prepared for what is to come, and I do like that. Looking at the short term, they have assets of $430 billion, and their liabilities come in at $1.20 trillion. These very high short-term liabilities are for the most part, as in, 71%, from low-risk sources such as customer deposits and interbank borrowing. These are kind of important because it does help Scotiabank manage its liquidity and operational needs effectively, maintaining stability in its financial operations. On the long term, we have assets of $960.44 billion and liabilities of $117.50 billion. Finally, in the last year, there has been some share dilution, a total of 2.6%. This debt situation is not that bad for a bank. And there are positives in it as well. I am very happy to see their cash and cash equivalents looking very healthy indeed. Okay, I think we have enough data for me to make that final verdict on Scotiabank. I like the data that I see with Scotiabank, and there is no doubt that they are a solid blue chip investment that will pay off well on the longer time scales. On the short term, they are still going to struggle, but I do believe they will inch up as they move along, and continued rate cuts will help them with that for sure. The good news is that the longer it takes the recovery, it does provide investors a chance to continue adding to their positions and get in on their yield, which is fantastic for a blue chip bank. As they slowly move up, you do have that nice quarterly dividend to keep you company. Passive income investors will more than likely be looking to the covered call bank ETFs to gain their exposure to Scotiabank with an opportunity for some great dividends. They do lose out on the upside potential, but they do get some nice income in exchange for that. HMAX from Hamilton and BKCC from Global X are just two of those covered call ETFs. Overall, I think this is a seriously good investment for the mid to long-term investor with a focus on stability and long-term capital appreciation. This is, without any doubt, one of those circle the wagon foundation stocks that I absolutely love. I do hold Scotiabank in the 0 to 100K challenge for just that reason. If you are interested in Scotiabank, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Loblaws. Thank you for watching, and I will see you in the next video.